the fun bit about this is you're mostly speaking to people who are probably sort of likely to be in agreement with you. So this does feel like preaching to the choir. I didn't know I was going to do it actually in a church, which is a bonus prize. I just wanted to spend 10 minutes briefly talking about, I think, the three areas that are going to, I think, act as potential barriers to what should be a growing movement. I don't want to start the day with a sort of negative, but I think the reality is there is demand, I think, for impact, or broadly speaking, sustainable investing, and a great sort of frustration with why isn't it more widespread? What is stopping it taking off further? So the three areas just to pick on, and this reflects both my experience with Kingfisher and my recent experience with Ben at Manhattan in launching a slightly different type of investment trust, are the role of corporates, the role of pension funds, and then the role of the asset managers, and particularly the way asset managers are measured and classified. The first thing on the role of corporates is that I think we're now seeing a generation of corporates coming through who are thinking about a business as a broader impact. It's not sufficient to try and create shareholder value, and frankly, if you set out to create shareholder value, you'll probably fail. You have to do something right which will ultimately create shareholder value. It's that way around. And we spent a fair amount of time at Kingfisher trying to understand both our mission in terms of what really generated the real reason why we were in business, and then how we could have a positive impact. Because we felt ultimately the next 10 to 20 years, companies that simply do marginally less evil are not going to be as successful as those that identify where they can have a positive impact, being a force for good. And the two key reasons for wanting to do that are essentially business related, which is if you really can have a business that does that, you have a long-term sustainable future. And by definition, your terminal value should be more valuable than someone who's only going to be around for 5 years or is in a sector which is in some way threatened by shifts. And secondly, in a world which is really going to be about harnessing talent, skills, and the next generation of people who want to work for you, your ability to attract them will be materially impacted. I mean, the example I would give most people at the moment is, can you imagine what it's like being the graduate recruiter for Volkswagen right now? And it's just like, yeah, come work for us, we're really great. And people are going to have, I'm sure they'll recover from it eventually, but it's going to leave a massive stain on that business and their ability to generate exciting 21st century talent. And I think the engagement factor that I've seen inside our business when I was at Kingfisher, of people being proud about the fact we were going to positively impact by the nature of our operations rather than just settle for less evil, was a really key factor in creating an energy and dynamism in the business. And I think there are going to be differentials between businesses who are able to really motivate their teams and really engage them in a longer term conversation than the quarterly cycle of reporting. So I think the corporates are beginning to stir, and I know there are sort of same old names, but one of the experiences working with Ben in Manhattan has been looking at the number of public companies out there that are in very interesting places. Typically we're focused, and I don't want to steal all of Ben's speech, but the resource efficiency areas, there are some really interesting plays happening where people are well positioned to take advantage of the shifts that we will see. And I think these companies will become more visible. But the final point I want to make on corporates was in 7 years as CEO and 17 in the business, I did quite a lot of investor conferences, and with the exception of the specialist investment funds and the specialist governance groups within the larger houses, I was only asked once about my net positive strategy or my environmental ambitions for the business. And frankly, I then talked about it because I felt, the corporates have to make the case for it, because on the evidence of my experience over 7 years, I'm not going to get asked about it. But what really sort of bugged me about that lack of conversation is it reflected a more important truth. Is that the reason we weren't having the conversation wasn't that these people aren't bright and interesting and thoughtful about the future. The problem is that there's no way of a pricing mechanism reflecting the stuff that we're doing showing up in my share price. And that's the bit, the sort of lack of pricing of the really true externalities of this is the thing which is probably the biggest missing link and the biggest inhibitor for some of the corporates to make the move and put their head above the parapet and say, look, I think there's a different model out here. And I don't have an easy solution to that, except that the area I think it should be somehow located in is if everyone is crunching models of future DCF value of the business, think very hard about your lifetime value at the end. That terminal value, different discount rates for higher quality or different, more sustainable companies, I think produces quite a different outcome. And I think what you're going to see here is potential arbitrage, and certainly that's the hope with Manhattan, is that the market's not correctly pricing this at the moment. And there is a real value opportunity to be in the right place for the next generation of companies that are going to succeed. But the companies and the corporates and the next generation of leadership in corporates are coming through. There is a desire to be more than, if you like, greed motivated, because I think it's a more intelligent version of capitalism, which is we want a sustainable version of capitalism, which is positively engaging the people in it and moves us forward from this, frankly, rather negative view of the world, which has led to some of the issues we've seen in the last 5 to 10 years. So I think the corporates are beginning to move, but we don't have the pricing valuation mechanisms, and we certainly aren't having the conversations with the people who actually make the fund management decisions. We're filling, by the way, in a hell of a lot of surveys and a lot of indices and lots of data, but it's still not necessarily driving investment decisions. And I think from the corporate point of view, I can tell you that's a bit frustrating. Second element is, I thought the people that might be able to sort of take a slightly different view would be the pension funds. Because I thought, well, you've got a 30-plus year liability profile. You've got to sort of think in a rather different term from a one quarter driven sort of hedge fund. And what I found, again, not having really known much about pension funds, and I went by going to talk to my pension fund at Kingfisher, because I was thinking that there are a couple of projects here we could really do interesting stuff. If I could carpet 300 B&Q ceilings, roofs rather, with a set of solar panels, if I could do something on long-term forestry and reforestation, if I could do something on our supply chain. And I got this very positive, cheery reception, which was great, followed by, of course, we can't do any of that. And I went, okay, that seems a bit odd, it is the pension fund of the people working in it, surely it's part of this sort of broader ecosystem. And the thing which became very clear very quickly, and this has been repeated elsewhere, is that two things that have driven pension funds out of this space, and again, I'm not quite sure what the answer is, but the two things are this obsession with sort of liability-driven investment, which has got everyone buying nothing but long-term gilts and bonds, and so the ability to hold other asset classes, let alone a sort of 30-year view on, actually my job is to pay future pensions. The answer is I've got this liability. And that has distorted, I think, the market to such a degree that large swathes of traditional places for long money have just disappeared. And I think there has to be a sort of reassessment of, is that really the right way to run a pension fund? The second aspect of the pension fund, which really actually frankly did shock me, because I suppose I hadn't asked the question before, was how the mandate works in terms of evaluation of performance. And the sheer lunacy of having a 30-year liability investment vehicle measured on relative quarterly performance or monthly performance in some cases is gobsmacking. I mean, it is completely ridiculous. And it has driven all sorts of entirely internally logical behaviour, because if that's what you're doing and you get mandates and you get stroppy letters from pensioners saying, I've noticed you're behind the benchmark, it's sort of inevitable that you'll end up with this. But the combination of that liability-driven investment and this sort of relative performance mandate, I think has created a really unfortunate set of consequences, whereby theoretically a large amount of long-term patient money is not actually doing its job. And a big chunk has been replaced by, you could argue, by some of the sovereign wealth funds or some of the other areas, or areas like, say, some of the Canadian pension funds who have taken a very different view and are, as a result, I think, playing in very different areas. But I think what it shows for us, I think the UK, frankly, has got it wrong in the way we set up our pension funds in terms of mandate and performance. And again, I think as a challenge, this is not unfixable. Other people seem to do it. What would it take? The final area, which is probably my area of steepest learning, courtesy of the process of going through an IPO with Ben, who showed that patience is a saint, I think, from time to time. So I'm really thrilled that Manhattan is part of the SSE now, and we look forward to actually getting the money to, well, we actually already got the money to work, but getting on to the next stage and building the fund considerably over the coming years. But the learning was, again, areas you don't ask about until you actually have to ask about them because you're involved, was how the assets are sort of viewed from the point of view of classification. And one of the biggest challenges Ben and the team had to do was to try and fit into a classification. It was like, well, are you an income fund? Well, a bit. Are you a growth fund? A bit. Are you in public? Yes, but we're also doing special situation. And what became clear was that some people really couldn't work out what the hell we were, and as a result couldn't give us any money because they couldn't fit us into the box system of where their money has to go. And I understand exactly why those things are there, and it's a conversation before saying, is that the fault of the consultants? Is it the fault of the way the industry has driven performance management? To my mind, the measurement classification meant that a very interesting approach, which is unconstrained, more long-term, more mixed classes, but with an overarching philosophy, which is about resource efficiency and longer-term sustainability, found it actually really, really hard to raise classic sort of wealth management money and bigger institutional money. Now, I think that will gradually change as we can demonstrate more of a track record. But from our point of view, it was a significant barrier to the start of the process. And again, I think there are just sort of, in all these three areas, the corporates, the pension funds and the asset management industry, there are sort of essentially unintended consequences of very sensible things. And I think the challenge for something like SSE and the member parties of it is to say, well, how could that actually, if those are the barriers, by definition, how could that create some opportunities? Because at the moment, the market isn't getting this right. I think over a 10 to 20 year view that this will swing round. So in that period, being very basic about it, I think there's an arbitrage between people's understanding now and their understanding later. And there's an opportunity to have a very interesting business opportunity as a result of that shift. And I think it will come. So good luck with today. It's a really interesting topic. I look forward to hearing a lot of people I know on the first panel. They're very high-powered indeed. And I would just sort of finish as one of the few sort of corporate types here to set a real plea on the corporates to say corporates really do want to be engaged in these sorts of conversations. They need a little bit more, if you like, real-time, real-level dialogue with the people that actually run money. If they can have that, and we can start to see valuations being reflected, then you will see, I think, a huge response from the corporate sector, and it is keen to do itself because actually it sees how it can profit from these very important changes we're going to see in the next 10, 20 years. Thanks very much.